Good morning, folks. Welcome back. We're going to be preparing ourselves for the 8:30 release of news. And then we have another 10 o'clock session, medium impact. So we should have a little bit of volatility today. The pound, obviously, you've been probably following along in Twitter. I'll talk about that this morning. But we're going to look primarily at what we could potentially see for the 8:30 numbers release. And let's go over to the charts. And I want to actually begin with the dollar, so let's go there first. Okay, so on the daily, we've come down into the range we were looking for, but nothing's really happened beyond that. I mean, yesterday's low was about it. So we're seeing a little bit of a consolidation in here. And I'm going to be real honest with you. As we get closer to the U.S. election, we're probably going to get tighter in terms of volatility. In other words, I think it's going to get more compressed. I think this will probably happen also with the equities market as well. I think we'll probably see the same thing with the bond market. And obviously that'll translate itself into the foreign exchange market. There's a lot of like wait and see. And I hate to sound like, the United States president has the whole entire globe, on edge. And it sounds very arrogant as an American saying that, but just simply look at what's going on. We have the potential of putting, what do you say about that? You got two people, that really don't deserve to be in that office. So either one could really do some damage with us, with relations with other countries, and we could very easily find ourselves in war. And I think that's really ultimately the outcome. I think we will be at war. And I think anyone that's been paying attention knows that's what's going to happen. So because of that, war is a very effective instrument with the markets. It does a lot to turn markets around. And I think we'll probably see a lot of consolidation going into November 8th. So it's important that we keep our focus on intraday trading, even if you don't like that kind of trading. I think that's primarily where everyone should be. I don't think anyone should be focusing on these bigger time frame moves for long-term or swing trade ideas. I think we're going to have a lot of knee-jerk reactions to short-term market releases like we're going to see today. And it's important not to get so overconfident about where the market may go. So in other words, we want to be dialing back, okay, or lowering our expectations to get very easy trade setups that doesn't require a lot of pips, a lot of movement. Whereas in normal conditions, I would expect to get anywhere between 75 pips to 100 pips really easy through the course of a week. I'm going to be real content with 25 to 30 pips. And if I get 50, great. Okay, but I'm going to be looking for 25 to 30 pips until we get to or on the other side of the U.S. elections. And I'm okay with missing moves that may happen that goes beyond that. I really don't care. I'm not here to, prove that, I can make more pips than someone else. The main thing is that we're trading to make money. And if you're looking for setups and you can identify the environment, which I see that we're probably going to have a lot of what I'm describing here, I think it'll be a low volatility condition until November 8th. We'll probably see a lot of fluctuations as the numbers come in, okay, and as the tallies start showing who may come out as the leader, then the markets might start to work towards the sentiment that's been built in. But until we get really essentially to the other side of the election and actually see who they placed in office, and notice I said that, not elected, I think that that's when we'll see the markets actually start to release again and have a little bit more movement. They won't be on bated breath waiting for the next thing. So with all that preamble, let's get into it. The dollar, we have a little bit of a liquidity void in here. Okay, so if we see the low broken here, the objective would be to see it come down to 98.10 to 98.05. It could spike down into 98 big figure, and that would give further upside release for fiber and cable. We are sitting inside of this down candle here, and I'm not too terribly excited about that as a bullish scenario. We did get the bounce that we looked for off this order block and closing in this little bit of a gap, but that's all we've done. We basically came out, closed in a little bit of the range here, and then immediately we've sold off. I don't see the dollar completely unwinding, and that's why I don't want to really see it go down here. I want to see this low and maybe see a consolidation in here, even with all the high impact news that's available for today, all the way through 10 o'clock in the morning. Ideally, I'd like to see the dollar be able to shrug off anything that would indicate bearishness. Okay, and here's a perfect scenario. What I mean by that, if you go into Forex Factory's calendar, you can click on the reports, and it'll give you like a synopsis of what it is, what it usually indicates. And while I'm not a big fundamentalist, okay, but I do like going back and looking at the reports and what would be deemed bullish in the terms of the data. If that data comes out and it's bearish today, okay, say it should indicate bearishness for the dollar. If the dollar doesn't go down, that is one of the situations I like to see, because then it's showing underlying strength, and that's really what I want to see. I think ultimately, the dollar's going to go higher. I think we're going to go into those, $1, $1.02 post-election. That's what I personally believe, and that's what I'm expecting, and that's what I'm looking to get in line with my trades. But obviously, because I have that bias or expectation, I'm not going to force it. I'm not trying to impose that will in the marketplace, but that's what I'm expecting to see, come in the marketplace. So while we did have a little bit of a rejection up here, ultimately I think we should consolidate as an ideal scenario. Now here's the thing: the market can consolidate on the dollar and still allow all kinds of trading for foreign currency. You can be buying and selling, with the fact that the dollar being in a consolidation and holding the levels that it's at here. Okay. So don't think that simply because the dollar is in consolidation that the other markets like pound or fiber or even Aussie and Kiwi, all those other markets that's paired against the dollar, they can still move. It doesn't mean that you have to see consolidation in those pairs as well. We're just going to focus on pairs that have strength or weakness overlying. So we'll do fiber real quick. Okay, going into New York midnight, that's what we're showing here with this blue line. We had the market come down, create a small little turtle soup, and we'll look at this scenario as well with the cable, because that's what set up the move that was seen in London that you saw on Twitter. But we had the liquidity void in here, closed in with this move down, also with it running the stops below this low. If I were to ask you right now, and I'm not going to look at the questions panel, so you can, don't be terribly excited. I'm asking more rhetorically because of the recording that everybody will be basically watching later on. Sorry, I gotta. The where would the liquidity be at today? And based on what I've described so far for the dollar, if we're expecting dollar to remain in consolidation, or if it drops down, either scenario, I don't see it running higher today. It could, but I think more likely it's the dollar's going to stay in consolidation or drop down to that lower liquidity void. that would give bullishness for foreign currency. We mentioned that 109.50 and all the way up to this up candle in here. So let's note that. So 109.64, basically 109.65 and 109.50. So it's real close to the same scenario we saw with cable in terms of levels. Okay, so that would be a reasonable expectation on the upside. And I don't want to see price go below. I don't want to see price go below 109.15. So as we look at price right now, in New York, it's roughly 10 minutes before 8. So we are going into the heart of New York session open. So ideally, we want to see price start to drift lower, going into 8:20, 8:30. Okay, and if it hits this candle's opening at 109.16, okay, so in other words, we could be a buyer at 109, we'll just say 109.20. Okay, so price would have to come down through 109.20 and hit the order block's body, okay, the 1 hour candle's body. That would be an ideal scenario for the New York session, and the expectation would be we would see range expansion to run up and hit into this 109.50 with potential to run through it on a spike up to that 109.64, which is we're rounding to 109.65. But even if that's where we're looking for, where it could potentially go, we're really going to just use the 109.50 level. So the question is going to be this: if price can retrace down and it offers us an opportunity to be long from 109.20, does that permit describing what I said earlier about targets and what we should be looking for? Should that be viewed in line with what I outlined as far as a realistic objective? Yes. Okay, 25 to 30 pips. So if at 8:30 or going into 8:30 we see the market trade down in here, okay, we can take a long. Now the question is going to be, if we go long there, where would our stop need to be? Well, we don't want to be below this. Okay, we don't want to be below we don't want to have it that tight. So the stop loss is going to have to be below the mean threshold of this down candle. Okay, so you don't want to see price come down below 109.04. Okay, so we have a 26 pip stop. No, what am I saying? Good grief. What is that? That's 16. I have a 16 pip stop, or basically, we'll just say 20. So we have a 20 pip stop with a potential payout of 109.50 on a limit. So we'll take partial profits at 109.50, leave something on just to see if it wants to run to 109.65. The gearing isn't going to be a 5-to-1 scenario, and I just explained that in the beginning of the video. So if you just signed in, you're hearing this, oh, this isn't a 5-to-1 setup. I know, I didn't say it was. I think that we need to be focusing on really low-hanging fruit going into the next week or so. Okay, so keeping that in mind, that's why I'm electing to trade with this format. You have to adapt with the marketplace. Otherwise, you're going to try to do things you shouldn't be doing. You're not going to get the results you're hoping for, and it'll be very frustrating. So let's drop into a 15-minute time frame. Okay, and you'll see how those levels are viewed on a 15-minute basis, and why I like to go with an hourly chart. There's a whole lot of busyness in the 15-minute time frame. I like how it's been building. All these candles here, these 3 candles in succession, the range from that opening down to this body's low, midway point of that, that's where it's respected. So it's seen new buying there. Price came back down into this down candle. It was new buying seen there. Price came down into this down candle here. It was new buying. So we're going to look for price to come down into, now again, we used an hourly chart, so the hourly chart is going to have more significance than the 15-minute time frame. So we're going to be looking for price to come down into this level, which you wouldn't normally expect to see on a lower time frame, but because of what I'm describing in terms of the volatility, the conditions of the market today, we're going to be looking for price to come down into that level, offering potentially the 109.20 level as an entry, and then reaching up for the levels as indicated here. Looking at the cable, we had yesterday's highs. Obviously, textbook clean, left them intact, and it was just above these over here on Tuesday's high. And we noted yesterday the mean threshold of this up candle. And price, during the London session, we had price drop down. Now, let me zoom in here because I really want you to see this. Notice how if you're watching price right after midnight, if you would have saw this, okay, that would indicate, for those that just watch my videos and the free tutorials, and they don't do any kind of study, they don't practice, they don't look at several examples, and they don't look at where the higher time frame chart or charts are indicating price should go, they could very easily justify this as a sell, because they would look at this and say, okay, well, here's 2 equal highs, which, you know, that could happen, but I don't like to have it like that. I mean, I want to see a little bit of time between the highs to justify it. Like, these are very clearly seen as clean highs. Two candles to this close proximity. On an intraday 5-minute chart, okay, then yeah, okay, it makes perfect sense to expect that. But for London, you want to see it actually run out something more significant, and you don't want to see that as a Judas swing, as an up move, and sell into that, because the underlying condition was, as we described yesterday, we have the mean threshold over here. The market showed a willingness to want to come off of this low, and we already saw the move up through all the down body on this candle. So we have reasons to expect price to go higher on this whole framework, and we don't need it to go 100 pips. We're only going for a run up to what we described yesterday with 2263 and 122.50. But we had these equal highs in here, and the fact that we had this low in here. So the question is, we don't want to see price go up. We could care less about that after midnight, and this is what I'm trying to get you to do. We had a member say that, you know, I'm taking trades in the dark and no one's able really to learn from that. I'm just giving you what you should be seeing, because right now, the first 2 months, you should be practicing with the things I've already given you. In November, you're actually seeing me do these things and outline it in advance and walk through every stage of what's going on. That was already explained to you in advance. That's the format for the 3rd month. But if you have not been practicing and you're just watching the videos, you've really wasted your time, because it's meant for you to get in there and look for these things and have them noted on your chart, whether you demo trade them or paper trade them, or do what I asked you not to do, which is trade them live right now. You're wasting, and you have wasted that time, because you could have been in the charts looking for it. So you really didn't take advantage of the first 2 months as you should have, and I've instructed you to do certain things. So if I'm talking about a specific direction in the sessions, or if I'm drawing your attention to specific levels, I'm really just pulling back the veil to try to tell you what side of the marketplace to be looking for. And some of you are still trying to trade the other side, and you're looking for things that I'm trying to keep your attention focused on the other side of the marketplace. And that's where the learning comes, because you'll see after the fact, okay, when it becomes hindsight, you'll look at the chart and say, okay, now I can see why he was talking about that level. I can see now why that level was significant. So therefore, when you go into the chart looking for justification for why that level should have been hit, then all of a sudden your perspective on the tools will be very clear. Then the order blocks will jump off of the chart and say, oh, there it was. I didn't see it at the time, because you're coming in with your preconceived notions about where you think price is going to go. And you're either arm wrestling with my analysis or you're just not listening. And I'm trying to bring all of you, to submission. Okay, you're going to have to submit. If I'm talking about a specific level, you just got to accept that I'm the one that has the most experience. So please just listen. And if you focus on where I'm trying to draw your attention, use the tools that you already know, and you'll start practicing more efficiently. And it doesn't matter if you get it right. Even if you don't get it right and you do submit to the things and directions I'm talking about, you'll learn by not doing it right even better. That's where the real learning comes from. So a lot of you are actually looking for me to say, okay, this low right here, we're going to wait for the market to trade down below that. It's got to be a turtle soup long, okay, and we're going to buy right there. Well, you already know that we were looking for 102.20, I'm sorry, 122.50 and 122.63 yesterday. That's where we were calling the market yesterday, okay? I don't need to tell you that that's where those sell stops are going to be. You should already know that. So if price drops down below that in London, right there, what would that be indicating? They're tripping the sell stops. So they're doing that to knock those individuals that are out, already in the market long, or tripping those individuals that want to be a breakout artist and sell short below this low. So they want to activate that sell stop liquidity so they can be a counterparty to it for their buying. Then all of a sudden now it suddenly makes sense because, okay, they want to come down below a previous low to absorb and accumulate sell side liquidity because they want to be counterparties to be a buyer. Why would they want to be a buyer down here? Because all of the liquidity that's resting up here that they left intact at a previous day's high. Remember back what I told you in September, previous day's highs, old lows, okay? That's where the orders are. That's where the real money is. That's where the real setups are. It's not in just the order block. Okay, the order block is to facilitate your entry. But again, the number one premise is, where's the market most likely going? If you have that in mind, you won't see these things here as a potential sell. You just wait for it to do what you really want to see, come down below the lows to take out sell stops. Okay, so if it takes sell stops out, also clears out these levels over here as well for good measure, you can be a buyer down here. Now, I just simply turned the chart on, and I noticed that it had just wiped out that low, and without even thinking, because I know, because I've been doing it so long, I know that that's what it was. That was a setup right there. Now, as I went along, I would have liked to have done it as it went right through the low, but I was in this candle here after it happened. I like to see it when it happens, but like I was talking about yesterday for the cable long that I took in London previous day, I used basically, I knew I was in close proximity of where the low had been violated, okay? And since I was so close, I'm okay with taking that trade. Now, the ideal scenario would be as price trades down through it, if you can be in the charts live as it happens, as it trades through it, and this candle would be all down right here. The wick wouldn't be there. It would be just a big black down candle. That's exactly when you want to be a buyer. And that's how you practice. You need to be practicing when the market's doing that, when it gives you that scenario. Because if you can train yourself to buy in those conditions, when the candle is 100% bearish, there's no wick, there's nothing that looks bullish about it. That's what you have to do to train yourself. And that's what you should be doing going forward when you're practicing. Because you're going to be doing a lot of that by drills and exercises and intended targets for setting those types of conditions up in the marketplace all throughout the third month. So all during November, you're going to have a lot of work. And if you don't do those things, I promise you, the fourth month, you will be behind. You will have already fallen behind. And while that's something that you can still overcome because everything's recorded, it's just a little bit frustrating, to know that if I'm going to tell you to do it and you're not going to do it, you're not going to get the results that you were probably hoping for. And I know that you can get in this mentorship if you do what I'm asking you to do. So by having that low swept this morning in London, the expectation would be to see the range expand on the upside to reach for the liquidity, resting at 22.63, and obviously the 122 mid figure up here, as we outlined yesterday. Price doesn't spend much time at all, explodes up, runs right through the highs here, and I actually had a limit order at 22.67, and it didn't hit it. It did not hit it. It left me in the marketplace and didn't give me the offering of getting out. So I took partial profits as we ran above these highs here. Okay, and you saw that on Twitter. And the market came down, and I had a stop at 122.20. Came down, hit the stop, so I was knocked out, and I'll send the screen capture of that stop out at 122.20. It stopped me out there, and I watched it come down and hit this. And I asked everyone, I said, look, now, it already ran up and hit our objective. No, I'm referring to what I said on Twitter now. I said, okay, we've already seen price run up, expand, hit the 122.63 level, clear up the 122 mid-figure level. Okay, and the question was, where is liquidity at now? Where is it? I apologize, I'm parched, so you're going to have to bear with me. As the market came down, closed in its void. Okay, now here, look at this. These are the types of things I want you to have on your charts. And like when you print your charts, or if you're looking at charts and you're watching price, while you're new, and I have to actually remind myself about this because I don't really do it the real time. I don't do it while I'm watching price. I instinctively do it because of experience. But while you're new, you need to do these things because it's going to highlight what you need to be focusing on. So your charts are going to be a little bit more busier than mine. And in fact, this chart's way busier than it is for me when I'm trading. But because I'm teaching it to you, and I also have to remind myself about certain things because I tend to take for granted that you should already be seeing it. And that's a weakness on my part as a teacher because I get ahead of myself sometimes. So when we're looking at charts and when you are looking at your own charts, when you see the down candle here and this big explosive move up, and you have this candle here trade down a little bit but then run away, you need to immediately highlight that area. Just like this. Okay? As soon as you see that, highlight it. That right there, okay, is a liquidity void. There is no wick in here, so there's no liquidity. It's not a fair value gap. This is just a liquidity void. Once you identify it, it's the top of that candle up to any wick that works down into this up candle. Okay, that's where you stop it at. Then you just extend that out in time. And I'm putting it right at the bottom of that candle right there. And as soon as you see that, and it would look like this on your charts as it happens, it's like there, it explodes up. Then you have this candle here. So immediately, right then, that's when you would highlight that area. Now, as price is running up here, everybody on baby pips is going to be buying British pound USD up here because it's going higher. You're not. You're going to wait. And you're going to wait for price to drop down into that area right there. And here's the thing. As this candle is all black and all down, 100% down, the opening on that candle is at 122.06. The low is 122.06. Okay? So, and again, precision, that's how the price is being delivered. They offered it on the buy side here. It came back down through here. So from this low over into this candle, from this candle's high in this area right in here, they offered it on the sell side of this candle, the range from its high down to this point here. It was offered on the sell side when the price was going lower. because notice this candle opened here. It traded down. So in this entire range here, the market was offered on the sell side. So all this up move here was now balanced out. But it left this pocket of price action in here only offered on the buy side. So in other words, there was forced price action in here. So to be efficiently delivered, the algo will drop back down into that and offer that level right here to close that in. And this is basically, all this is basically, it's a common gap. But because the markets are electronic now, there's no common anything. It's an absence of liquidity. Okay, so the market will go back down, offer that price level again, and fill in this entire up candles range that's only been exposed to when the market was going higher. So they offered it down here, closed it in perfectly to the pip, and that's where you want to be practicing buying. You want to buy it there. Now here's the thing. If you do that, okay, you don't need it to come all the way back up to here. All you need to do is see where the bodies are. The bodies of the candles are right here. So if we look at that, okay, so we have a range of 2234. So you would have a limit order right above 2234. So we'll aim for the round number, well, not round number, but the 5 level, 2235. That's where your limit order would be. So as price would slam down in here, the way you practice is, okay, you identify the void, you know the bias is higher, and here's the thing, you don't even need to see the high be violated. You're trading inside the range. We know that this was expansion for running on stops. It reached for liquidity. How do we know that? Because it's all wick. It was unable to maintain that price action. So therefore, we adapt and say, okay, now I am only going to focus on where the bulk of the volatility is, or volume, not volatility. So it's going to be at 122.35. Before I go any further, I'm going to ask those that are live, did I lose anybody about what I just said? When I ask a question like that, all I'm looking for is yes, because it's a lot easier to find it because a lot of people start saying no. Okay, Gina, I lost you. I didn't mean to say your name or call you out. I'm sorry. The idea is if we're bullish, okay, and we're still in London, we've seen, what is this movement here when price starts to, thank you, I appreciate everyone responding. I have one person, and that's all I need is one person to tell me they weren't able to see it. What is this move here? This price leg up. It's an impulse price swing. Okay, so we wait for price to come back down. Okay, now think in terms of equilibrium. Are we at discount down here or at a premium based on this price swing up? This would be discount. And we're trading with IPTA in mind, the interbank algorithm. It's going to offer that price back to us again. If we understand that the price should be sensitive at that level, okay, we don't require or need price to come all the way back up here to make a profit. As price trades down, and as the candle was down here before it turned into a wick, as it hit that, we could be a buyer right there with the expectation of seeing price move up to 122.35. So my question is this. As price hits this candle and closes in this range, we're going to say you probably get filled around 22.10. So from 22.10 to 22.35 on a limit, does that offer you a tradable opportunity? In other words, is it a manageable trade where you can see profit and can risk be defined? Okay, so if you're buying down here as it closes in that range and say you get long at 22.10, you could have a stop below the middle of this down candle. So if you have a stop below the middle of this candle here, or if you went right to the body's low, okay, what is that essentially saying? You got basically a 10 pip stop, right? Close, like 12 pip stop, something like that. Okay, so you have about 12 pips at risk. You don't require the range to be expanded through what's already been posted. You're focusing immediately on where the volume is, the bodies. So the liquidity is going to be resting right above 22.35. So if you have a 12 pip stop and we get long at 22.10, we're at 10 pips here, 20 pips here, 25 pips. So we're risking 12 to get 25. So we have 2 to 1. Now, is that 5 to 1? No. But is this something that you can practice in? Yes. Is it something that gives you immediate feedback? Yes. Do you have to get out the entire position at 22.35? Light bulbs just came on. No, you framed the trade. The underlying setup is at 2 to 1, yes. But if you take something off at 22.35 and leave something on just in case it wants to run, that's what you do. That's how we do all of our trades. All of our trades, we have ideally an opportunity to leave something on to see if it wants to pay a little bit more. But we don't require it. We will already be paid once it gets to our level. So price trades down, runs away from it, goes into consolidation, and runs immediately. Right here on this candle, I'm sorry, on this candle here, your 22.35 is violated. Okay? Notice how price goes right back up into that same level, 122.63, which is the mean threshold on the daily candle we identified over here on the left side. If you've taken 3/4 of your position off that you took long from over here, okay, and you had 1/4 or 1/3, let's say 1/3 of your position on still from 22.35. You pick up another 30 pips, essentially, almost, on the back end of that trade that you would not have expected or demanded. You don't need that. You've already had a trade that's framed out with 22.35 on a limit based on the bodies of the candle. Trading with the directional premise that was already established yesterday using the levels that we were looking for. Okay, so the liquidity is above the bodies of the candles in here. The direction was what? Up. Fair value. Discount. Okay. And what else do you see here? I see your question, Kim. Give me 1 second, okay? What else do you see here outside of what I've already identified? Well, yeah, we already mentioned it was time of day, but it's London session. But more specifically, what's all this here? We have this candle here. Does it have an up close or a down close? It's a down close. So immediately to the right of that candle, do we have an up close or a down close? Immediately to the right of that candle, is it an up down? I'm sorry, is it up or a down close? Down. And then we have another down close here. Okay. So what we're seeing here is we have price offering us another order block. But because it's all succession lower, 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 okay, even if we didn't see this candle here, okay, because I bought before that candle even happened. I didn't see this candle yet when I bought. When I bought, I was long before this down candle was even on the chart. I was in over here. So if we understand that this entire block of price action down here we use the whole entire part of the bodies down to the lowest portion of the body, this candle right here. Okay? So when price trades out of that range, which it does right on this candle here, see that? It violates that right there. You see that right there? This candle's high is violated right there. See it? So even if you're not a turtle soup trader, or if you can't see it yet, don't worry about it. It'll come to you. Don't rush it. As soon as this candle trades through the beginning of all these down candles, this is the entire order block. They were buying all the way as it was dropping. They're buying, they're buying, they're buying, they're buying. They drove price through the low to buy and run out the stops to force in more sell-side liquidity. So if they're seeing down movement like this, you know they're reaching for the stops, or you should know it. Even if you don't see it ahead of time, don't worry about it. Wait for all this move here to be violated. On the upside, it does it here on this candle. It breaks through this down candle's high. So basically what you did was we affirmed that this is now a qualified bullish order block. So this level here becomes sensitive going forward, 122.18. So if price drops down into 22.18, into the range, what range is that, Michael? Well, we focus on the bodies of the candles. So the mean threshold would be here. I'm using this little thing as a little, like a marker. Draw that out in time. You can see we only went like 1 pip below the mean threshold here. But it also lines up with a new point of reference that now is here with this down candle. See that? So it only came down to close in the range that was offered by this candle's high or its opening, which is, again, 109. I'm sorry, 122.06. And the low on this candle comes down exactly to 122.06. So you have all these things overlapping. So when price comes down like that, it hits it, gives you the opportunity to get long. Now let me ask you a question. Say as price was to trade down to here, say the candle starts trading up, and I wish I was in my recording because I could actually turn this into a down candle with graphics, but say the candle hadn't come all the way up here yet, and say it was still here, but the wick was from this low to here. If price was right here, after it had come down here and it starts coming off and it starts rising up, it didn't come all the way up here yet. If price was right here, could you be a buyer? Now, I know it's easy because you can see price actually in hindsight, but my question is, conceptually, could you still be a buyer? Okay, why would it still be okay? Very good. Casper, the first one that said it. That's the one I'm looking for. There you go. It's in close proximity to what would frame your entry. Okay, so you don't need perfection. You don't need it to go right to the order block and you have to be right in then. You don't need that. If you understand the context of what the market is offering you, you can get really close to what would be the ideal scenario for entry. Think about it. Am I not doing close proximity exits when I do trades? Because that's what I'm teaching you. I'm telling you to get out before the ultimate objective, yes? All I'm doing is getting out before I know a high probable level. And today's a perfect example of why I tell you it. I had a 22.67 limit order in, and it went just 2 pips shy of it. And it was actually a little less than 2 pips. It was so close, but guess what? Not enough. Close ain't enough. Okay, so if I'm comfortable getting out early, being in close proximity to where I think the market should go, and I'm okay with that. I'm still refining that as a trader. I adopted the first thing was I learned that I don't need perfect entries. And that's why I'm trying to tell you, you don't need your entries right now. You don't need signals. You need to have understanding why the market should do what it's doing. Because once you have that, it releases a lot of that uncertainty and that rush to be doing something because you know that it's going to be easy for you to find the next trade setup. So if we see price all the way up to here, is that still an acceptable buy? Absolutely. No, it is. Absolutely, it's good. Because what you're doing is you're trading right at the candle's bodies. Okay, you're basically buying right at the top of what would be the bullish order block, right? If we were buying up here, okay, after we saw price reject the mean threshold, once it pulls away from that, think about what the mean threshold is. That's the last line in the sand. Now, if the trade is good on a bullish order block, if it trades down to the mean threshold and finds some support there and moves back up, in a perfect scenario or a high probability scenario, would price go back down to that mean threshold again before going higher? No, it should not. So my question is, if you can see these things lining up and understanding where you're at in terms of institutional order flow, because that's what we're teaching here, you could be a buyer up here, and whereas your stop loss would be below the body of the candle here if you were down here, if you were buying up here after you've had confirmation that the market has shown willingness to respond off the mean threshold, and now it's up here, where could you place your stop at? Just a little bit below mean threshold, right below here. Because, and this is what everyone's struggling with, and this is the reason why it's important you practice, because you won't trust it, you won't believe in it until you see it over and over again in your charts. That's why I'm telling you, go back and look at these things that I described in the first month, September, what you should be focusing on. If you spend all of your time looking at hindsight examples of price action, you don't need, and I'm going to throw this answer into one of the guys that sent me a question about why I don't look at back testing. Well, I don't talk a lot about back testing. And I used the same scenario I used for my own mentor. Larry Williams said, I don't need to walk down the street, walk past a blue house with a white picket fence and have a dog bite me and tear my arm off almost. I don't need to walk down there 3 times, 4 times, 6 times to realize that when I walk down there, this dog's probably going to cause me some physical harm. These lessons are so generic. They're based on sound principles. So once you see a sample size of it, and it can be done over a course of 1 month, you don't need to prove that there's going to be liquidity voids, liquidity pools, time of day analysis. These things are very generic. They repeat themselves so consistently. You don't need 300 trades. You don't need to have 5 years of data. So yes, you can take it to that extreme, but my point is, once you start studying it, you'll see that if you were buying up here, it makes perfect sense to put your stop loss down here because you understand that the algo has already offered that price level, closed in that gap. So if it goes back down to that level, guess what? You're on the wrong side. And you'll know why you got stopped out. Or even better, if it's more of a range than this, sometimes you can say, well, I'm going to protect my stop and just collapse the trade. And there's no shame or no harm, and there's no, in other words, it doesn't make you less of a professional trader. In fact, it makes you more of a professional trader by collapsing your trade and protecting your stop. The stop is the last ditch shield or defense. You don't want to see your stop loss hit, but you're willing to absorb that if you're wrong and it doesn't give you a chance to get out. So when you do your trade, you want to frame them where you'll know if the trade's good while you're watching it. If you can, be in front of the charts and watching it. But if you can't, at least you know you have a hard stop in place, and that's your safety net. So the question, Kim, if I want to make sure I understand it. You're questioning why would we be long after it ran up here to 2263 and it came all the way down here? Is that what you were asking earlier? Why would we even consider buying it again? Or did I not understand your question? The fact that we only went up to the mean threshold, okay, and we rejected, we still had this intact over here. We had the low violated at 21.99 or the 22 big figure stops. They were ran out over here. And we saw a big run up. So when they run up like this, we don't know, okay, we don't know if that is continuation on the higher time frame or if that was rejection. We never know that right away. That's why I'm telling you, just because we have bearish order blocks or upside objectives, that doesn't mean that I'm a seller up here at 2263 just because I'm calling that level. And that's where a lot of folks get confused. If the market's down here, and I'm talking about 2263, that's a target. That's all that is. I'm looking for that objective. So simply because it hits that level doesn't mean I'm going to be short or a seller. I would be like this selling it, obviously, as a long exit. But when price comes back down, you got to remember, we had really strong price action up here. So when price shot up like that, we can get a tradable bounce on that impulse swing. And that's the power of what I'm trying to teach you, that you don't need a lot of pips. You don't need a big range, and you don't need a 100 pip range to know that trading inside this range that we created with these bodies, forget this wick's even here. Forget that's there. Just focus on this impulse price swing here, just in the bodies. So when price trades back down and gives you an opportunity to get long again, you can frame it that this is where the institutional order flow is going to reside right above the bodies of the candles, and that frames a trade that you can trade and get long in. And who cares if it just would have went up to 2237 and then rolled over and took out the initial day's low? Who cares? You would have made 25, 30 pips. That's what I'm trying to get you to understand, that they are bread and butter setups. They happen every single day. Does that make better sense now, Kim, or did I not? Yeah, if I didn't answer, then say so. But yeah, that's the one thing that I'm going to try to convince you not to do. Just because we can see institutional order flow reference points above the marketplace, resist the notion that you're Spider-Man, that you can swing from high to low to high to low to high to low and trade from long to short to long. Don't think that you can do that, okay? I tried to do that as a younger man, and believe me, it's more difficult than it seems when you're looking at charts. Just try not to do that. Focus on the setups that make sense. All right, so we had price offer one more time, the 2263. Now here's the thing I want you to take away also with the cable. Let's assume for a moment that we didn't even look at the daily chart yesterday. I didn't talk about the 2263 level. Okay, nothing was indicated about that level. No mention of it was made. Okay. Look at this price action. There's nothing up there to indicate why 2263 or 2265 would be an objective to see reactions like we're seeing, right? In standard technical analysis I'm referring to. We have equal highs up here. Be careful with that. Fiber is not. It might not give us that drop down. For euro dollar, I would not want to be a buyer down in here at this point now because we ran out of high after the news. So I don't want to see it come back down. I'd like to see the high, if we're bullish, kept in place because they've already taken the buy stops now. They've already done that. They didn't come down to go lower, then run the buy stops would give our setup. It hit the buy stops first, and I don't want to see a retracement back. So I want to see them leave the buy stops intact, drop down, let everyone chase it going lower. We be buyers in that condition, and then run it through, reaching for the buy stops. See, what they did was they ran it through right on the news. Now think about what's already happened. The market's already been going higher intraday. So they pushed it through to a new high, and that's why we're seeing some weakness in here already, because they've already unloaded. They've unloaded above the bodies of the candles in here. Look how perfect they are. So they wick through that, offered their longs. So I don't want to be a buyer if it comes back down in here, but I'm more interested in cable